When investing for the long term, it's hard to look past the benefits of personal deductible contributions to superannuation. These voluntary super contributions allow you to reduce your personal income tax while building your retirement savings in a low tax environment. In this video, we'll explain how personal deductible contributions work, who can benefit from them, and the steps to implement the strategy effectively. Personal deductible contributions are voluntary contributions made to your super fund from after-tax income. When you lodge a valid notice of intention to claim a deduction, these contributions become concessional contributions, and you receive a personal tax deduction. The tax deduction is claimed in the financial year the contribution was made, assuming you've allowed sufficient time for your super fund to process the contribution in that same financial year. Once accepted by your super fund, the contribution is taxed at 15% rather than your marginal tax rate, which can be as high as 47% when the Medicare levy is included. The benefit is the difference between those two tax rates, often a significant saving. Let's look at an example. Ben is 50 years old and earns a salary of $200,000 plus super. He decides to make a $6,000 personal deductible contribution to maximize his concessional cap. This table summarizes how it impacts his position in the current 2025-26 financial year. As you can see, under both scenarios, Ben's gross income is $200,000. However, under the proposed scenario, he uses $6,000 of after-tax money to make a contribution to his super. This brings Ben's taxable income down from $200,000 to $194,000, reducing his personal income tax payable. After factoring the $6,000 that's gone into superannuation and the reduced tax payable, Ben's net income reduces from $139,862 to $136,682. If we then look at the superannuation side of things, Ben still has employer contributions of $24,000 under both scenarios, which is a standard 12% superannuation guarantee on his $200,000 income. Under the proposed scenario, he also has a $6,000 personal deductible contributions, which takes his total contributions up from $24,000 to $30,000. Given the additional concessional contributions, tax payable within his super fund increases from $3,600 to $4,500. Total net contributions after factoring in the tax are $20,400 in the current scenario and $25,500 in the proposed scenario. So at the bottom of the table, we summarize the benefits. If you look at the current scenario, his net income plus net contribution is $160,262 versus under the proposed scenario where it is $162,182. The total tax paid under the current scenario is $63,738, and under the proposed scenario, it's $61,818. The total difference is $1,920. So as you can see from this example, by making a personal deductible contribution of $6,000, Ben will reduce his personal income tax by $2,820, but increase his tax on super contributions by $900. This gives him a net tax saving of $1,920. A $1,920 tax saving on a $6,000 contribution is the equivalent to a risk-free, tax-free return of 32%. Before making a personal deductible contribution, it's important to ensure you meet the eligibility requirements. Firstly, there's age restrictions. You must be under age 75 to make personal deductible contributions. If you are between the ages of 67 and 74, you will need to meet a work test which requires working at least 40 hours over a 30-day period in the financial year. Alternatively, you may also be eligible for the work test exemption. And there are contribution limits. Personal deductible contributions fall under the concessional contributions cap limit. In the current 2025-26 financial year, the cap limit is $30,000. Employer contributions and salary sacrifice contributions also fall under this cap limit, so be sure to factor that in. You may also be eligible to utilize unused carry forward concessional contributions if your super balance is under $500,000 as at the 30th of June the previous financial year. After assessing your eligibility, making personal deductible contributions is relatively straightforward. Here's a step-by-step guide. Firstly, you need to contribute to your super. Make a contribution to your super fund using your after-tax income. You can do this as a lump sum payment or regular contribution throughout the financial year. Your super fund will be able to provide EFT or BPay details to do so. Next, lodge your notice of intent. You must inform your super fund that you intend to claim a tax deduction for your contribution. This is done by lodging a notice of intention to claim a tax deduction for a personal contribution form. You lodge this with your superannuation fund before you lodge your tax return or by the 30th of June the following year, whichever of those comes first. Next, you will receive an acknowledgement. So you need to wait for an acknowledgement from your super fund confirming that they have received and accepted your notice. Without this acknowledgement, you cannot claim the tax deduction. And finally, claiming the tax deduction. When completing your income tax return, include the amount of your personal deductible contribution in the section for tax deductions. This will reduce your taxable income and the tax benefit will be calculated based on your marginal tax rate. Quick tip. We often advise our clients to make their personal deductible contributions at the end of the financial year prior to the contribution cutoff date. This allows us to accurately assess existing contributions which have been made in the current financial year and also the anticipated remaining contributions still to be received in order to ensure we are contributing the right amount. But before making a personal deductible contribution to superannuation, it's important to consider the following potential risks and disadvantages. 1. Contribution cap limits. As mentioned previously, you need to ensure you are working within the contribution cap limits. If you exceed your current year's cap limit plus unused carry forward amounts, tax implications will apply. 2. Limited access to funds. Superannuation savings are preserved until you meet a condition of release. For most people, this condition is reaching preservation age and retiring from the workforce. There are some instances where you may be able to access benefits earlier, such as release on compassionate grounds, financial hardship, or under the First Home Buyer Super Saver Scheme. 3, you need to understand your investment strategy and fee structure. So before putting any additional money into superannuation, you want to ensure you understand and are comfortable with the investment strategy and fee structure within your super fund. And 4, Division 293 tax. For high income earners, if your combined income and concessional contributions exceeds $250,000 in a financial year, you may face an additional 15% tax on some or all of your super contribution, totaling a 30% contributions tax. Making personal deductible contributions to superannuation can be a very powerful strategy to minimise tax and build your net asset position. Superannuation is the only structure that gives you a tax deduction for investing for yourself. Typically, we reserve personal deductible contributions for phase 2 and onwards of the wealth creation process. However, it may also be appropriate for first home buyers utilising the First Home Buyer Super Saver Scheme in phase 1. If you think making a personal deductible contribution to superannuation is an appropriate strategy for you, we strongly recommend you speak with your financial advisor. They can help assess the appropriateness for your particular situation. Please note, the information contained in this video is general in nature only and does not take into consideration your objectives, financial situation, or needs. As legislation is constantly changing, the accuracy of this information is only current as at the time of recording. Before relying on the information, you should check to see if the content is still relevant.